Welcome to the StockOptionsAssassin.com's Trade of the Week. In this week's video, we are going to look at an earnings play in Netflix that involves selling premium. So let's go ahead and just kind of look at Netflix's chart. You can see Netflix kind of rolled over here. This was on December 24th and really had a pretty huge drop over the past month, 6-8 weeks. And we're kind of coming into what could be potential support. We'll call it 310 here. You have a big round number 300, should be stronger support. And we've pretty much had this pretty big sell-off straight into earnings. So earnings are tomorrow, the 22nd, after the bell. So you have time to get in this trade today. I'm actually going to wait until tomorrow, and I'll show you what I plan on doing for this trade. So what we're going to do is an earnings play, and we're not going to really pick a direction. I really have no idea what Netflix's earnings are or what they're expected to be. What I do know is the premium is super high and we've sold off into there. My expectation is that even if they disappoint earnings, that the sell-off could be somewhat contained because it's already sold off. Now, it could very well, they could have very good earnings and this thing could rally hard. So what we're looking for is a contained sell-off or a hard rally after earnings tomorrow, and that's the play we're going to set up. And we're going to set up a put credit spread, and let's go ahead and just look at the option chain here. So these are the weekly options. We have 3 days left to earnings or to options expiration, and you can see the implied volatility is a whopping 128%. So I'm going to expand this. And so what we're looking at is what the potential market maker move is. So you can see it's up here in this box where you see the MMM market maker mover, and right now that's about $33. You can also see over here where the implied volatility is that it sets about $34. So let's call it 33 bucks. As of right now, as of doing this video, it's about lunchtime on Tuesday. Remember, we didn't have trading yesterday. As of right now, the options, the weekly options, are pricing in about a $33 to $34 move over the next 3 days. Okay, so let's go back to the chart. So right now, Netflix is trading at $323. So if we go $33 below that, that would put us at about $290. So let's just draw that in real quick. We'll draw a little line here at $290. Oops, you edit properties here. I'm going to make this 290. I'm going to make this red, and you'll see why in a minute. Okay, so this is the expected move from where we're trading right this second. From 323, the expected move is $33. Now, it could go $33 up, or it could go $33 down, excuse me. And you can see that coincides right with these levels. So there's, it's going to be well below the 300 line. And so what I want to set up is a put credit spread where we sell the 290. So we're going to simply change this to vertical. And you can see if I sell this put credit spread, we would be selling the 290 and buying the 285 for protection for a grand credit of $1.02. And that's if we can get filled. So there's already a little bit of volume going here. So let's say we get $1 for this. So what's our risk? With the $5 wide strike spread, if Netflix stays above 290 over the next 3 days, we would collect all of that credit. If the earnings were super disaster and it blew through these levels, then we would be risking $4 per spread. But the market maker move is usually pretty consistent. So the best thing that could happen actually is that Netflix trades sideways to up. And let's just look at the potential volatility crush. So if I go in here and change this to theoretical price, and remember we said it's about $1, and so let's say tomorrow, and then if we have the typical volatility around Netflix is about 80%. Right now you see 60%. Right now it's 128%. So if we were to lose minus 48% in volatility, look how much the spread would be worth, 29 cents. So if Netflix does absolutely nothing, we could sell something for about $1 and it would pretty much go to about 29 cents, and eventually it would go to zero because it's way out of the money over the next couple days. So that's the play we're looking at setting up. Again, if we go to sell this, remember you're going to get about $1 credit. We are selling the 280, or excuse me, selling the 290. Let me duplicate this one. and we would buy the 285 put. Oops. And change this to green because that's the one we're buying. Okay, and we're collecting a credit. The ultimate goal is for both of these options to go to 0 before Friday. Now, if we sell off into those levels and it kind of holds and it chops sideways, we would eventually be able to collect all or some of the credit. So that's the trade of the week. We're looking at a put credit spread. A lot of people will do this on both sides, where they will sell the put credit spread 30, in this case $33 down, but they'll also sell a call credit spread at $33 higher, and that creates an iron condor. So if it stays within that on both sides, then you would collect credit on both sides. In this case, the way that it's sold off so hard in earnings, I'm a little skeptical of selling the call credit spread, because if the earnings are good, this thing's going to rocket right through it and it may blow past that. So I'm favoring I'm favoring a sideways to upside move. However, I only want to play this with the options that are below. So hopefully that helps. You guys have a great week, and we'll talk to you next week.